In this session, I will discuss with you how exchange rates are decided in an economy. To appreciate how exchange rates are decided, let us first begin with what do we mean by an exchange rate appreciation or an exchange rate depreciation. Now, let us consider two scenarios. In the first scenarios, I required 70 rupees to get $1, and in scenario 2 I needed 80 rupees to get the same $1. Now, when we are considering scenario 1 and 2, when I am moving from scenario 1 and 2, many of you would agree that the rupee has depreciated when we move from scenario 1 to 2. Now, if you see, compared to scenario 1 and 2, we are moving from a smaller number 70 to a bigger number 80, and we are saying that the rupee is depreciating. This may appear counterintuitive to many. Now, how do we ensure that we are depicting an exchange rate depreciation and it is also intuitive? To appreciate that, we need to depict exchange rates as per the definition. The definition is how many units of foreign currency that I can get per unit of domestic currency. Then why I am representing it in this fashion? Where I am representing how many units of domestic currencies will trade for 1 unit of foreign currency. We are depicting it in this way for convenience, but if we stick to the definition of exchange rate, the correct way to represent it would be how many units of foreign currencies I can get per unit of dollar. Now, if we consider this, the scenario 1, this can alternatively be represented as rupees 1 is equal to $0.014, and I am representing it as 1A just to ensure that I am presenting equation 1 in an alternate fashion. Now, similarly, equation 2 can be represented as rupee 1 equal to $0.012, okay, and this will be my equation 2 alternate version. Okay, now we are saying that when we are moving from scenario 1A to scenario 2A, I am getting less units of foreign currency for the same 1 unit of domestic currency, and in that sense the rupee is depreciating, and it is now intuitive because I am going from a bigger number to a smaller number. Please keep this in mind when we are talking about exchange rate appreciation or depreciation. It is always with regard to this form of representation. Now, suppose you were initially at rupees 1 equal to $0.012, and the second scenario you move from here to $0.014, then what can we say? Initially, if we were at scenario 2A and we are moving from 2A to 1A, what is happening? I am getting now, earlier I was getting only $0.012 per 1 rupee. Now I am getting $0.01 for the same 1 rupee. I am getting more units of the foreign currency, and in that sense the rupee is appreciating. So when I am moving from 1A to 2A, the rupee is depreciating, and if I am moving from 2A to 1A, the rupee is appreciating. Okay. Now we will consider the demand for rupee in the foreign exchange market and the supply of rupee in the foreign exchange market vis-a-vis dollars to find the value of rupee vis-a-vis dollar. Now, if I present it in a graphically, what I am putting here is here I am putting the number of units of dollars you can get per unit of rupee, which is in the form of which is in the form of rupee 1 equal to 0.012 dollars, okay, and not in the form of 80 rupees equal to $1, okay. This alternatively implies that I needed rupees 80 to get $1, so I am not using this representation, I am using this form of expressing the exchange rate. Now that means if as I move, that means if it is 0.010, this will be 0.12, this will be 0.014, say 0.015, 0.16, and likewise. So as I am going up along the y-axis, I am finding or I am depicting that the rupee is getting appreciated. And on the x-axis, what I have? On the x-axis, I am putting rupee traded. Okay, so we are considering how much of rupee is traded in the foreign exchange market, and I will consider the supply of rupee and demand for rupee in the foreign exchange market. And who are the people who are demanding rupee? Who will demand rupee? Somebody who is interested to buy either Indian goods or Indian assets. He need to pay in terms of rupees. So somebody, a foreign investor or an importer who has got dollars but who wants to buy Indian goods or Indian assets, he would like to convert his dollars into rupees. In that sense, the foreign importer or the FIIs who want to buy equities and bonds in the Indian equity market or in the Indian capital market, they are the people who are demanding rupee because they have dollars with them and they want to use or convert these dollars into rupees to buy Indian goods or Indian assets. Okay, and so the demand is demand for rupee. Who is showing the demand for rupee? They are the people who are suppose FIIs or say importers in foreign countries, okay. And who is supplying rupee? The suppliers of rupee in the foreign exchange, supplier of rupee, who are they? People who want to buy goods and services which are priced in dollars. Suppose we are talking about rupee dollar exchange rate. Now people who are interested to buy either goods or assets which are priced in dollars, they need to convert rupees into dollars. Okay, so like here, who is it? This is an importer. Okay, let us consider an importer. Now a domestic importer who has got rupees, he wants to buy things which are priced in dollars, so he wants to convert his rupees into dollars. So when we are talking about demand for rupee and supply of rupee, let us see how they respond to the different levels of exchange rates. Okay, let us consider two scenarios which we have already seen, which is the first scenario was rupees 70 was equal to $1, and scenario 2 was rupees 80 is equal to $1, but I am not putting here in terms of 70, 80, but I am putting here in terms of 1 upon 70, 1 upon 80, how many units of dollars I can get per unit of rupee. Okay, this I am putting again for notational convenience. Okay, now let us consider the demand for rupee. Somebody who wants to buy Indian goods, suppose a foreign importer wants to buy Indian goods which are, when Indian sweaters, say suppose sweaters are available for 1000 rupees, and the foreigner wants to import sweaters worth $100. That means the foreign importer has got $100. He wants to buy sweaters from India to sell it in US. Now how many sweaters he can buy? You would find that with $100, it will, how many sweaters he can buy will depend on the exchange rate. Now if the exchange rate is 70, he will be able to buy how many sweaters? 100 into 70 by the price of the sweater, so this will give 7 sweaters. Now if the exchange rate were 80, the same $100 would have given him 8 sweaters. So what we are finding, when we are moving from 70 to 80, the rupee is depreciating, and when rupee is depreciating, the foreign importer is able to get more goods and services for the same dollar. Okay, now what, when you are getting more for the same dollars, it will create a greater propensity to import goods from India. We can look at it from the asset purchases. Suppose yes, a FII is interested to buy, suppose Indian equities, and the Indian equity of, say, company A, which is selling at 200 rupees. Okay, now with same $100, with 70 rupees, he can buy how many units of the company A's equity? You multiply $100 into 70. Now here it will be 200 rupees. So he will be able to get 35 units of the company's A's equity. Now if the exchange rate were 80, he would be able to buy, now say 40 units. He would be able to buy 100 into 80 divided by 200. It will give 40 units of company A's stock. So because you are able to buy more units of stocks for the same $100 when the rupee is depreciating or at a depreciated level, what it would trigger? It would trigger an increase in imports by the US importer, or it will trigger greater purchases of equities or financial assets. So this fact, if I would depict in graphically how it would look, what we have said is that when the exchange rate is relatively depreciated, so that means this 70 was what? 70 was giving rise to 0.014, okay, and 80 rupees was 0.012. So what we are saying, whatever the demand for rupee was at 0.014, now the demand for rupee will increase when the exchange rate is at 0.012 or at 80. Why? Because with the same dollars he is now able to buy more goods or more assets. So the same thing I can represent through a downward sloping demand curve, which tells that the rupee traded increases as the rupee is depreciating, because this D is what? This demand is demand for rupee. This is demand for rupee by whom? By people who have dollars or who want to convert their dollars into rupees. Okay. Now, as far as the supply of rupee is concerned, or domestic imports are concerned, this is representing foreign imports. Okay. If as far as the domestic imports are concerned, naturally, if I am an importer and now instead of selling goods abroad or selling assets abroad, what we are trying to consider is, suppose we want to import toys worth say $100 from US. Now if you are a toy trader, you are importing and toys from US and selling it in India, and suppose you want to import toys worth $100. Now if the exchange rate is at 70, you need to arrange how much money in rupee terms to get this $100 worth of toys. You need 7,000 rupees. Okay, but if the exchange rate is 80, you would require now 8,000 rupees to buy the same $100 worth of toys. Now what it leads to, because to buy the same amount of goods in dollar terms, because I require more rupees when the exchange rate is depreciating, I would be rather reluctant to import more when the exchange rate is at a depreciated level or at a lower level. Now if the exchange rate were say 70 or say 60, I could get the same $100 worth of toys by arranging relatively lesser amount of rupees. So what we are saying, as the rupee is appreciating, as we are moving up, the rupee is appreciating, the propensity to import will be higher, because with the same rupees you can get more goods in dollar terms, or to get a specific amount of goods in dollar terms you require lesser rupees. So the same fact I can represent by a upward sloping supply curve, which what this supply curve is telling, supply of rupee for conversion into dollars. Okay. That means if you see, the demand curve is depicting demand for rupee by people who have dollars, and the supply curve is depicting supply of rupee for conversion into dollars. And where the demand and supply curve intersect, my equilibrium exchange rate will be decided at that level. Maybe this is somewhere between, say, this is 0.013, okay. So this is how the exchange rate will be at a particular level at a given point in time, governed by the demand for and supply of rupee. Now we can see how different forces have a bearing on the exchange rate. And let us start from a point where the rupee dollar exchange rate was at a particular point, governed by the forces of demand and supply. Okay, so let us depict that. This was my rupees, this was my rupees traded. Okay, and this is, here I am putting how many units of dollar I need to get 1 unit of rupee. Okay, so as we move up the y-axis, the rupee is appreciating. That means this will be, say, 0.01, 010, 012, 014, 016, 018, like this, because the numbers are increasing, and now it is intuitive that as we are going up the y-axis, the rupee is also appreciating. And this was my initial demand and supply curve. Okay, now what the demand and supply curves represent, it should be now fairly clear. Now let us consider certain scenarios. Suppose the FIIs develop a disinterest in the Indian economy because the macroeconomic fundamentals are not very strong. Suppose the GDP growth has been lackluster, there is inflation is relatively high, and you are finding fiscal deficit also is increasing. The government has not been able to stick to the fiscal deficit target that it had mentioned in the budget. So all these factors are creating negative sentiments about the Indian economy. Now what that would do, when negative sentiments are created, these negative sentiments reflect that the growth prospects in the economy is not going to be great. Now your return on investments, when FIIs bring money, put money in the stock market or in the bond market, they are expecting a particular return, and that return to a great extent is governed by the growth prospects of the economy. Now if those growth prospects go down, now what that would result in less demand for Indian equities, and when less demand for Indian equities, there will be less need for converting dollars into rupees to buy those assets, those equities and bonds. So that will be causing a leftward shift in the demand curve for rupee. And so initially, if I was at point A, the new equilibrium, because the supply curve has not changed or shifted, so I get the new equilibrium point at point B. Now what it is also telling, that the rupee traded volume has declined and the exchange rate has depreciated, okay, say from 0.015 to 0.013. Okay, now this is one scenario where the growth prospects of the economy takes a beating, which causes adverse FII sentiments about Indian economy, which leads to a depreciation of the currency. Now sometimes it is said that when the FIIs lose interest, that leads to a depreciation of the currency, and why, you are able to see it from this diagram. Let us now consider another scenario, which is that oil prices are increasing, and because the oil prices have increased, to buy the same old quantity of oil you now require more rupees. Okay, so what that is leading to is an increase in the supply of rupees for conversion into dollar, because the cost of the oil has gone up. What that will lead to? That will lead to an increase in supply of rupees for conversion into dollars in the foreign exchange market. That will again cause a fall in the value of rupee from A to C, say maybe from 0.1015 to 0.014. Okay, now an increase in money supply, because the central bank or the RBI is following a easy monetary policy where it is increasing money supply relatively faster or by a bigger volume, which causes again the increase in the increase in the supply of money in the economy, which leads to a shift in the supply curve, and that again leads to a decline in the exchange rate. See, the trigger can be anything, but ultimately if that trigger is resulting in a shift of the demand curve or the supply curve, we would find the exchange rate also to undergo a change in its equilibrium value. By the way, when the RBI is pursuing a easy monetary policy, what you are finding, many of the importers are importing using borrowed funds. When you are making the cost of funds cheaper, what is happening? Because funds are available relatively cheaper, there is greater propensity to import, which leads to greater supply of rupees in the foreign exchange market for conversion into dollars. That will also lead to a fall in the exchange rate. Now we will consider a scenario where the RBI is pursuing a tight monetary policy. What it is leading to? A fall in the money supply, so naturally less money is available in the economy, and that is reflected in, say, in the cost of money going higher. And when the cost of money is going higher, means the interest rates are going higher, and when interest rates are going higher, some of the importers may find now at this increased cost borrowing becomes very costly, and perhaps they would like to refrain from importing too much, and that would be reflected in a upward shift in the supply curve. Okay, this you can visualize, either the RBI is directly reducing money supply in the economy, which is leading to less currency available for conversion into dollars in the foreign exchange market, and that is reflected through a leftward shift of the supply curve. So the new supply curve is S2. So what we are getting, maybe initially you were at 15, but now you will be closer to, from 0.015 you will move towards 0.016. in other words, the rupee will appreciate. Please keep in mind, this is point E, suppose. So we consider a scenario when the RBI is pursuing tight monetary policy, which causes the supply of rupee to be lower at each exchange rate, which causes supply curve to shift to the left, and that leads to an appreciation of the currency. Now sometimes the RBI says that it is trying to control inflation by pursuing a tight monetary policy. In the recent times, suppose we find both inflation is rising and the exchange rate is depreciating, though the central bank might explicitly state that it is trying to control inflation by raising interest rates or by pursuing a tight monetary policy, what in effect it might be also doing is, or the unstated objective would be to support the rupee at a particular level or at a higher level, and the unstated objective is achieved by the same monetary policy measure. We are saying that RBI can kill two birds in one stone when it is pursuing a tight monetary policy to control inflation. This tight monetary policy is also helping to support the rupee at a higher level, because the tight monetary policy is leading to a leftward shift of the supply curve. Generally, central banks don't explicitly state that they are targeting a particular level of the exchange rate. Suppose initially the exchange rate was at 0.016, and because of disinterest of FIIs, the exchange rate has depreciated to 0.015. Now, what RBI can do to again take the exchange rate back to 0.016 is it can pursue a tight, that means initially you were at, suppose at initially the exchange rate was at 0.016. Okay, that means initially the supply curve was initially you were at 0.016. Some forces have operated, maybe a disinterest of FIIs, which brought the exchange rate from 0.16 to 0.15. Now you are trying to support that, you want to take the exchange rate back to 0.016, and how you can do it without explicitly stating that you are doing so. When you are following a tight monetary policy, you are, suppose after the depreciation the supply and demand curves were at such that you were at A. Now you are trying to push the supply curve to the left so that you are somewhere reaching near 0.016. Okay, I hope you are clear. So often a statement is made that while the stated objective of a tight monetary policy is to control inflation, the unstated objective is to control the fall in the value of rupee, or in other words, to support the rupee at a higher level. That means you don't want it to be at 0.015, you want to take it back to 0.016. Now, in this context, another thing which becomes important to discuss is what is known as the exchange rate risk, and why the central bank might, if suppose somebody asks why the central bank is interested to, suppose initially you were at 0.016, for some reason you have come back to 0.015, and why the central bank again wants to take it back to 0.16. In other words, why the central bank doesn't want the rupee to depreciate. This we can appreciate if we consider the exchange rate risk that the FIIs face when they bring money or to invest in India, to take advantage of the interest rate differential that exists in India and other advanced economies. Let us see that. Suppose let us talk about carry trade. What is happening? The US Treasury bond, US Treasury paper is yielding, say suppose 3% per annum interest rate, and the Indian government bond, suppose, is giving a yield of 8%. Now this is pure a 5% interest rate differential. Now if And let us consider two scenarios. Suppose the exchange rate was at rupees 70 equal to $1, suppose. Now, if a foreign investors has got $1,000, what he can do, he can raise funds at he can this $1,000 he can borrow in US at 3%, because that is the rate at which funds are available, and in India it will bring the funds to India and will invest in government bonds, and which is a relatively safe return. He gets 8%, so there is a 5% net return he can make. And if the exchange rate is 70, how much that would translate to? So he is bringing in rupee terms rupees 70,000, okay, and on that suppose he keeps the money for 1 year, he will get a 5% interest that will make 3,500. So he will get a total of 73,500 at the end of the year. And if the exchange rate is at 70, how much in dollar terms he will take back? 73,500 by 70, it will be $1,050. Okay, so that means he had raised $1,000, he is taking back $1,050, so there is a $50 net gain he is making. But this is assuming that the exchange rate has not changed in the last 1 year when the money was invested at, and it remains at 70. Now, if the exchange rate has depreciated from 70 to 80, suppose it is now $1 equal to rupees 80, how much then he will get in dollar terms? Because in rupee terms he gets the same 73,500. Okay, now if I divide it by 80, how much I will get? I will get something which will be less than $1,000, because I needed 80,000 in the numerator to make it 1,000, so it will be something less than $1,000. Now the important point is, you have got $1,000 into Indian economy in dollar terms, and while taking back after 1 year, you are taking back something less than $1,000. Now this is not a very happy situation for FIIs, because they are actually losing out. Now why this loss has come about? Because the exchange rate has depreciated from 70 to 80. So often it is said that the interest rate FIIs are not governed, are not very much lured by the interest rate differential of 3 to 8%, means 5% interest rate differential between India and US, but rather they are also very particular about what is going to happen to the exchange rate, because they are facing a exchange rate risk. If the exchange rate depreciates, they are going to actually lose out. So if we want to make the Indian economy really attractive for FIIs, it is also desirable that the exchange rate is not allowed to depreciate significantly, because that would amount to disinterest of FIIs, and which ultimately will lead to a shortfall in the financial flows to finance the current account deficit. Because we have already discussed that India is a structurally current account deficit nation, trade deficit nation. Now that deficit needs to be financed through financial inflows. So you do not have much of an option but to really make your country and your policies really attractive for FIIs to bring their money into India. The dollars must come into India so that you are able to finance the deficit on the trade account. Now we just discussed how the exchange rate is influenced by the monetary policy. Like if the RBI pursues a tight monetary policy, it can support the rupee at a higher level, or it can help to prevent depreciation of the currency to some extent. And but the easy monetary policy, the exchange rate will depreciate. Now, in the recent times, say 6 months back, the forex reserves with RBI were 430 billion. Now, now it is somewhere around 400 billion. So, when the rupee was coming under severe attack, when the rupee depreciated because of oil price increase and FII's disinterest in the Indian economy, RBI tried to use forex reserves that it has with it to support or to prevent the rupee depreciation. That means RBI is now not using monetary policy but rather directly intervening in the forex market. Now, how can we represent that through the demand supply framework? That you can appreciate if instead of, because last time we discussed about in the x-axis rupee traded. So when in that framework, when I am talking about rupee traded, I cannot depict the direct dollar sell and purchase by the central bank. Now if I want to depict that, here what I will do, I will present dollars traded. Okay, dollars traded, and on the y-axis I will present, now we were presenting how many units of dollars you can get per unit of rupee, but now I will present here how many units of rupee you need to get 1 unit of dollar. That means now we will be representing the exchange rate the way it is reported in the newspapers, say 40, 45, 50, 55, 60, 65, 70, 75, 80, 85, and likewise. So when I move along the y-axis, actually the rupee is depreciating. In the previous case, what we saw, that the rupee was appreciating as we were going up the y-axis, because we were representing how many units of dollars you can get per unit of rupee. Here we are representing how many units of rupee you need to get 1 unit of dollar. Now with the changes in the x and y axis, our demand curve is now what? This is demand for dollar, and this is supply of dollar. Okay, now, and this demand for dollar and supply of dollar, suppose, gives us a particular exchange rate. Okay, and by the way, when we talk about RBI's intervention in the forex market, there may be initially a trigger for the depreciation of the rupee because oil prices have gone up, and which requires more supply of rupees in the foreign exchange market, and which leads to a depreciation of the currency. But once depreciation starts in some way, speculators then come into the picture and they try to drive the exchange rate to a particular level so as to make a profit. Now, how the speculators play their role, let us see, so that we can appreciate why the RBI is intervening and to what extent that intervention will be effective in preventing the depreciation of the rupee in the face of speculators trying to take the rupee to a new lower level. Okay, so what we will do, let us consider again, suppose initially the exchange rate was $1 equal to rupees 70. Okay, but the speculators are thinking, or they have an expectation, that the rupee will depreciate further to rupees 80 in the next, say, 2 months. What they will do, when you are expecting the rupee to depreciate as a speculator, you will try to buy dollars That means, suppose for notational convenience, let us take as a speculator you have 7,000 rupees. Okay, you have 7,000 rupees to begin with. Now with 7,000 rupees, what you can do, you can buy say around $100. Okay, you will buy $100 with seven. That means you will use 7,000 rupees from your pocket, or you will borrow funds with 7,000 rupees. You arrange 7,000 rupees and buy $100 as prevailing exchange rate. Now, because and if actually your speculation turns out correct, then you will be able to sell these $100 at 8,000 rupees after say 2 months or 1 month, so that you would have made a profit, you would have made a net profit of 1,000 rupees, isn't it? You are arranging 7,000 rupees, getting $100. Now when the exchange rate actually depreciates, you can sell it for 8,000 rupees, you would have made a profit. So the short point is, when the speculators expect the rupee to depreciate, they will demand more dollars. That means they will try to convert the rupees into dollars. Okay, so that means the demand curve for dollar goes up, or it shifts to the right. That leads to a depreciation of currency, say from 64 or 63 to say 68. Okay, because now we are presenting, as we go up, the rupee is depreciating. Now when this kind of a scenario you are faced with, now you don't want because you don't want the rupee to depreciate significantly, because it involves a exchange rate risk for FIIs, and you want to support the rupee at somewhere at its previous level. So what you can do, you can increase the supply of dollar in the market by selling directly dollars from your foreign exchange reserves, so that RBI, what it does, it tries to increase the supply of dollar. So the supply of dollar goes up in the foreign exchange market, so that the new supply and new demand again brings you back to the old exchange rate. So that means initially you were at A, because of speculation you went to B. Now you want to bring again from B to C. Okay, and C will be near around your previous level. Okay, this near around previous level. So this is depicting in the RBI's interventions directly in the foreign exchange market to support the rupee at a higher level. Now, sometimes it is said that fighting speculation is a losing bet, because RBI doesn't have that much of forex reserves to sell as much that may be needed to support the rupee at a particular level. Why? Because we do not know what would be the increase in the demand for dollar out of speculation activities. Suppose the increase is very high. Okay, so that means your new equilibrium moves to say point E. Now if you want to again bring it to a point around this, maybe you have to carry out more dollar sales in the foreign exchange market. And the issue is whether the forex reserves, whether the RBI has so much of forex reserves to really counter the drop in the exchange rate. Okay, so sometimes it is said it is better not to use scarce forex reserves to support the rupee at a particular level, because the exchange rate is a price, and let that price be governed by the market forces of demand and supply, rather than you trying to intervene in the market to support the rupee at a particular level. Now RBI's stated stance is what? That they don't try to target any particular level of exchange rate, but they try to remove undue volatility from the foreign exchange market so that orderly conditions are met in the foreign exchange market. Okay. Now, whether a depreciated currency is good or bad, it requires a more detailed analysis, which we will do to some extent. We have discussed as to how exchange rates are decided in the foreign exchange market, governed by the demand for and supply of either rupees vis-a-vis dollars in the foreign exchange market, or the supply and demand for dollars vis-a-vis rupee in the foreign exchange market. Now, when there are different views as to we have heard that the RBI has spent almost $30 billion of uh, forex reserves to support the rupee at a higher level. Um, the question arises whether the central bank should try to resist the depreciation of the currency either by pursuing a tight monetary policy or by directly intervening in the forex market by increasing the supply of dollars. Whether such policies are desirable, whether the central bank should at all try to intervene in the foreign exchange market, we will be able to appreciate whether the central bank should intervene in the forex market or not if we can evaluate whether a depreciating currency is good or not good for the economy. Now, to appreciate the role of exchange rate and the changes in the exchange rate and its impact on the economy, we will consider a few propositions that is made about exchange rates. The first is that the exchange rate acts as a shock absorber in the economy. Now, what do we mean when we say that the exchange rate acts as a shock absorber in the economy? To appreciate how the exchange rate acts as a shock absorber, let us consider that economy is running a high current account deficit or a high trade deficit, and this trade deficit was financed by financial inflows. Now, if for some reason the financial inflows stop flowing, what would happen? If this was my demand curve and this was the supply curve, this was rupees traded, okay, this was rupees traded, this was the dollars per unit of rupee, okay, and for some reason the exchange rate depreciates, and in this case we say that the forex inflows have stopped coming, which has led to a fall in the demand for rupee, okay, in the forex market, which causes a drop in the exchange rate, okay, a drop in the exchange rate. Now, in this kind of a situation, what we are finding that the exchange rate is falling. When the exchange rate is depreciating, our imports becomes costlier, and at the same time the domestic goods now look cheaper to the foreign buyers. This we can appreciate if we consider, suppose the foreign importer is importing sweaters and the exchange rate was, suppose it was corresponding to, initially the exchange rate was rupees 70 equal to $1, and which has become now after depreciation rupees 80 equal to $1. Now, if suppose somebody having $1,000, he could get 300, suppose the price of sweater was 1,000 rupees, Okay, then somebody having $1,000 could get how many sweaters? Somebody would get $1,000, 1,000 into 70 divided by 1,000, you will get 70 sweaters. Now if somebody is having $1,000, same $1,000, but the exchange rate depreciates to 80, now he will get 80 sweaters from the same $1,000. Now what it has resulted in, now with the same dollars, the foreign importer is able to buy more Indian goods. In other words, the exchange rate has made the Indian good look cheaper, okay, which gives a boost to the exports from the country. And on the other hand, now with rupee depreciation, imports has become costlier. So imports to some extent, imports will be also curtailed. So you are finding two things: exports are getting a boost and imports are seeing a decline, which will help you to restore your trade balance, which is export minus import. If you are having a high trade deficit, then if you are having a high trade deficit, in other words, the suppose if I plug in some numbers for getting the dimensions, suppose this was 200 and the import was suppose 300, so I get this is minus 100, which is my trade deficit, 200 minus 300. Now what I am saying, in this process, this trade deficit can be corrected if my exports increase from 200 to 250 and imports drop from 300 to 250, so we will get a zero trade balance. In other words, these numbers will now be 250 minus 250. Why? Because you can relate it to this. Okay, what is happening when the exchange rate depreciates? Exports get a boost and imports are adversely impacted, which is helping you to reduce. I have taken an extreme case, so that leads to a wiping out of trade balance. Now in this sense, because the exchange rate has depreciated, this has resulted in wiping out the trade balance. The exchange rate has acted as a shock absorber for the economy. That means if demand, if forex inflows are not coming into the economy, which earlier was coming, then you are able to you are that is leading to a trade deficit, and you are able to correct that trade deficit when the exchange rate is because the exchange rate has depreciated. In that sense, the exchange rate, some people say, it acts as a shock absorber. What happened in Greece was they did not have their own currency, so that this shock absorber was not available for them. In fact, there were thoughts in Greece that why not give up euro and go back to the old the Greece currency drachma, so that the currency can devaluate or depreciate, so as to again restore balance in the trade account. Okay, now let us look at some other views about the benefits of depreciation. We will consider the Indian case, where we are saying whether a depreciation really helps. Now many people feel that most of our imports are inelastic in nature, especially the oil imports. We import 2/3 of our oil requirement from abroad. Now those need to be paid in, say, foreign currency, say in dollars. Now as the rupee is depreciating, my dollar import bill is going up. At the same time, I am getting some positive impetus on my export front, but because my imports are inelastic, I am not getting the desired benefit from a depreciation. That means, if had imports been elastic or responding to prices, As the exchange rate has depreciated, imports should come down. What we are saying, this fall in M is not coming about. So and because we are having a situation where M is always higher than X, we are having a trade deficit all the time. So our increase in export following a depreciation will not be adequate to counter the the imports, which in any case is not coming down. Okay, so in that sense, whether a depreciation is really helpful for Indian economy. Now, to answer that, we have to take a more holistic view. When the exchange rate is depreciating, it is giving a boost to exports, and the industries which are export oriented, activity in those industries will be at a higher level, and maybe employment opportunities, newer employment opportunities are also created. So we cannot only look into the trade deficit, what is happening to the trade deficit following a depreciation, to form a view as to whether the depreciation was useful or not. So what we have said is, following a depreciation, ideally the trade balance should go in the country's favor, but in Indian case it might not go in the country's favor because our imports are non-responsive to the currency depreciation. Okay, so but then we are again saying that it may not be helping much on the trade on the trade count, but it certainly has an impact on the domestic economic activity, and we cannot lose sight of that benefit while forming an overall assessment whether a rupee depreciation is desirable or not. Many people feel that the recent bout of depreciation from 69 to current levels of 74, 75 was a much needed correction. So, just to summarize what we discussed about exchange rates, we we began with a framework or to understand how exchange rates are decided. We use the demand and supply framework. We consider two scenarios. We talked about either rupee traded or the situation of dollar traded, to get how the exchange rate, how the demand curve and supply curve for rupee looks, or the demand curve and supply curve of dollar looks, and that is giving us a particular exchange rate. And we spent some time in discussing how different forces can bring about a shift in the demand and supply curve so as to cause the exchange rate to either appreciate or depreciate. We also discussed about how a depreciation can really increase exchange rate risks and make the country more vulnerable to FII flows. FII flows would not be forthcoming in a great force if the FIIs expect that the rupee will depreciate in the days to come. And lastly, we discussed about how exchange rate acts as a shock absorber, and exchange rates to act as a shock absorber in the true sense of the term. We have to allow the exchange rate to really play its full course. Now, generally, it doesn't happen that way, but suppose the because of the rupee depreciation from 68 to 75, the oil prices, which was say around 65, has gone up to 75. Okay, in some cases it has gone to 80. Now we have discussed that our imports are insensitive to the exchange rate because our oil imports are inelastic. Now, oil imports are inelastic when the price of oil is increasing from say 65 to 75 or to 80. But if the exchange rate is allowed to play its full course, and suppose the RBI had not intervened, had not used this $30 billion of forex to support the rupee, and perhaps suppose the exchange rate were at say $1 equal to rupees 100, and government also doesn't try to fiddle with the market prices of oil and all that. That means you are not intervening in the forex market, you are not intervening on the taxation side, the tax applicable on petroleum products. All these, both these things are, suppose, is leading to a scenario where oil price is now say 110 rupees per liter. Now, if with 65 to 75 increase in the oil price, we may not find a great reduction in the oil consumption, but with oil prices moving from 65 to 110, which is almost a 60 to 70% or more than that increase, 70% to 80% increase, what that will do. Now, once oil prices increase by that great extent, people would start economizing oil. They will, suppose people who are using their own cars, maybe they go for carpooling. Then people, suppose, who have got one small vehicle and one and a big vehicle, they would like to use more often the smaller vehicle, which is more fuel economical. It will trigger different reactions which ultimately will cause a fall in the oil imports itself. That means our stance that M is unresponsive to prices will not hold if the oil prices increase really significantly. Okay, so exchange rate will act as a shock absorber if we allow the exchange rate to play its full course. In reality, we try to intervene in the forex market. We try to take measures to make inflows of dollars, to enhance the inflow of dollars into the economy. Because various measures we are taking, the exchange rate is getting support at a relatively higher level than where it should be, and that is perhaps leading to oil prices not increasing by a very high amount, which is not leading to that much of drop in oil consumption, so that we are finding apparently the exchange rate is not acting effectively as a shock absorber. But if you allow the exchange rate to play its full course, governed by the forces of demand for rupee and supply of rupee in the forex market, you would find that the exchange rate acts as a shock absorber for the economy.